Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at energy fuels.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into the absolute carnage on today's chart, just a quick note for those of you trying to make sense of these really volatile markets, we have a link in the description below for VIP Algos.
Oh, yeah, that's a great tool.
It really is. It's a TradingView indicator suite designed to be a visual aid for your charts. So, it highlights trend directions, plots out your support and resistance zones, and actually gives you visual buy and sell alerts. Plus, it maps out planning areas for take profits and stop losses.
Right, but we should be totally clear here.
Exactly. I was just going to say, to be completely clear, this is an educational chart analysis tool only. It is absolutely not financial advice. It does not execute trades for you, and it definitely doesn't guarantee profits.
Yeah, trading always involves risk.
All right, so you must manage your risk and do your own research. But if you want a cleaner, more visual way to analyze your setups across stocks, Forex, or crypto, definitely check that link below. It is an affiliate link, so we may earn a small commission if you use it at no extra cost to you.
Okay, so setting the stage for today's market story, we are looking at ticker UUU. And honestly, if you pull up the chart right now, it is just a scene of utter devastation.
Devastation is the right word for it. It's rough.
It's caught in this severe, relentless, multi-month correction. We were talking about a brutal 53.2% crash from its 52-week high, and that high was, what, $27.90 back on January 28, 2026.
Yeah, and today it's sitting around $13.05.
Right, that is the kind of haircut that just causes retail investors to panic, sell, and delete their brokerage apps. So the question we have to untangle for you today is simple but extremely high stakes. Are we just watching a falling knife in a sector that is violently correcting, or is this a completely misunderstood corporate transformation that the market is just, mispricing?
And that is the exact tension driving this entire narrative right now. Because, if you just look at the surface level price action, it is terrifying. The momentum is totally broken.
Oh, completely broken.
But when you actually look at the underlying business reality, like what the company is actually doing with its capital, it requires a totally different perspective. We're watching a company intentionally tear down its old business model to build something entirely new.
Which means we need to reframe how this fits into your wealth building context. Because, when a stock gets cut in half, your knee-jerk reaction is to assume the underlying business is failing.
Right. That's the natural instinct.
But to understand this aggressive sell-off, you have to understand the massive pivot they're attempting. Historically, the market just viewed this company as a short-term uranium mining play. It was super simple. You bought the stock when you thought global uranium prices were going up, and you dumped it when spot prices dropped.
Yeah, it was a trade, not a marriage.
Exactly. But that's no longer the case.
No, the identity of the company has fundamentally changed into a long-term critical minerals play. The entire portfolio fit has shifted here. They are attempting to build a domestic, non-Chinese, mine-to-magnet Western supply chain.
Mine-to-magnet, that's the buzzword.
It is, and that phrase is everything right now. It appeals to thesis-driven investors who are tracking these multi-year geopolitical shifts. This is no longer for, the speculative trader trying to catch a quick bounce on a Tuesday.
Let me try to visualize this for a second. Imagine a traditional oil driller. Their entire business model is just pulling crude out of the ground, and their profitability is completely at the mercy of global commodity prices.
Right.
Now imagine that same oil driller suddenly announces, hey, we're buying a massive electric vehicle battery manufacturing plant. It completely rewrites the risk profile.
100%.
You are no longer just managing oil rigs. You're managing complex manufacturing, international supply chains, and these highly engineered end products.
That analogy totally works, but let's actually make it a bit more severe. Because, an oil major usually has billions in free cash flow to fund a battery plant.
Good point.
Here you have a relatively small mining operation attempting to climb the entire value chain while still relying on volatile commodity prices to foot the bill. Pulling resources out of the ground in Utah is an entirely different universe than refining rare earths, engineering a permanent magnet, and then selling that highly technical component to an aerospace or defense contractor.
Yeah, the latter requires immense capital and deep integration.
And above all, patience. And right now, patience is the one thing the broader market just refuses to offer.
Which brings us perfectly to the fundamental numbers. Because if they're trying to build this massive mine-to-magnet moat, well, building a moat costs an absolute fortune.
It really does.
And when I pull up their income statement, I am genuinely confused by the math. The numbers are incredibly polarized. Like on the top line, things look fantastic.
Right, top line is strong.
Yeah, trailing 12-month year-over-year revenue growth is actually accelerating to 21.95%. They're also holding a solid gross margin of 34.58%. So they're selling product, and the base economics of getting that product out the door are healthy. But then I look at the bottom line.
It gets ugly very quickly.
Extremely ugly. The net margin is sitting at a deeply negative 82.7%.
Wow.
Earnings per share over the trailing 12 months is negative $0.3032. How exactly does a company accelerate its revenue by nearly 22%, maintain healthy gross margins, and still bleed cash that aggressively? Where is the black hole?
Well, that black hole is entirely intentional, and it's really the crux of the whole transformation. That massive negative net margin is the direct result of a $1.9 billion acquisition they just made for a company called VAC.
Okay, so VC.
Right, VAC is a major manufacturer of permanent magnets, and they don't just operate out of one warehouse. They have these complex manufacturing facilities across North America, Europe, and Asia.
Right.
So when you absorb a company of that size, you aren't just paying the sticker price.
You have to actually connect the plumbing.
Exactly. You are paying astronomical integration costs. You're consolidating different software systems, retooling factories to accept your specific mine materials, aligning management teams across different continents and time zones.
Sounds like a logistical nightmare.
It's massive. Plus, you're taking on massive capital expenditures and dealing with depreciation that absolutely wrecks your net income line in the short term. So the accounting looks terrible, but it's the cost of building the infrastructure.
Okay, but I mean, as an investor looking at the balance sheet, the skepticism has to kick in here. This company only has a market cap of around $3.30 billion.
Right.
Swallowing a $1.9 billion target means they are absorbing an asset that is more than half their entire valuation. That is a staggering amount of leverage and operational risk. Are they just biting off way more than they can chew?
It's a fair question.
Because if integrating those global facilities stalls out, or if the debt required to keep the lights on becomes unmanageable, that negative 82% margin isn't just a temporary growing pain, it becomes a fatal structural crisis.
And that is the multi-billion-dollar question that is causing this 53% drop. It's a high-wire act. Management is making a calculated, almost aggressive bet that they can establish a Western duopoly in critical minerals for high-tech applications.
A duopoly, that's huge.
Yeah, you have to look at the macro picture here. The switching costs for Western defense contractors, EV manufacturers, and tech giants to move their supply chains away from China are enormous. If this company successfully integrates VAC and controls the entire process from the mine to the final magnet, their competitive moat becomes virtually unassailable.
Unassailable, assuming they pull it off.
Right. You're absolutely right to call it the execution risk. It's monumental.
Which makes the timeline critical for you as an investor. If management is taking on this much fundamental risk with a massive balance sheet stretching acquisition, you need a reason to hold the stock through the pain.
Exactly.
We have to figure out what could actually trigger a turnaround or a re-rating in the next 3 to 6 months. What are the catalysts on the horizon that could prove this thesis right?
Well, the most immediate and vital hurdle is the upcoming Q2 and Q3 2026 earnings call. This is going to be the main event.
Right, because Wall Street is not going to care about standard revenue growth this time around.
No, not at all. They are going to demand surgical precision regarding the VAC integration. Analysts want to see a concrete timeline. They want proof of synergies, meaning, is the mining output actually feeding the magnet factories efficiently?
That's the real test.
Yeah, and most importantly, they'll heavily scrutinize the revised rare earth production guidance. If management can step up to the microphone and prove that the integration is actually ahead of schedule, that removes a massive cloud of uncertainty. That alone could trigger a violent upward re-rating of the stock.
But we also can't ignore the macroeconomic weather because it directly impacts their margins.
That is a critical point. We have to look at the broader monetary environment, specifically the recent confirmation of Kevin Warsh as the Federal Reserve Chairman.
Right. Warsh.
Yeah, if you look at his historical policy leanings and the current economic data, we might see policy adjustments that intentionally or even unintentionally weaken the U.S. dollar.
Let's break that down for a second because currency impacts can seem really abstract. How does a weaker dollar actually help a domestic mining and manufacturing company?
It acts as an invisible margin booster.
Oh, interesting.
Yeah, globally, massive commodities like uranium, rare earths, and critical minerals are priced in U.S. dollars. When the value of the dollar falls relative to other currencies, those commodities suddenly become cheaper for foreign buyers to purchase.
Which drives up demand.
Exactly, that drives global demand up, which naturally pushes the nominal price of the commodity higher. So without changing anything about their day-to-day operations, a weaker dollar directly pads the margins of a domestic producer. It's a massive macro tailwind.
Okay, a weaker dollar makes total sense as a catalyst. But let's separate real macroeconomic theory from the rumor mill for a minute.
Boy, the rumors.
Yeah, because right now, the message boards and the financial press are just swirling with speculation about the Department of Energy handing out massive grants or defense logistics contracts being awarded to help subsidize this new domestic magnet manufacturing footprint.
Well, to be fair, the logic behind the rumor is sound. The U.S. government has a massive stated interest in securing non-Chinese supply chains, especially for military hardware that requires these exact permanent magnets.
It makes logical sense, yes. But hoping for a government bailout is a really dangerous game for an investor. Banking on unconfirmed federal handouts to fund an acquisition that is already choking your balance sheet is not an investment strategy. It's a lottery ticket.
Yeah, you can't build the thesis on hope.
Right, because if those DOE grants don't materialize, or if they just get caught in 2 years of bureaucratic red tape, the company has to shoulder that entire capital burden alone. Hope is not a catalyst. If they can't fund this internally, that is a massive red flag.
Which brings us perfectly to how the actual price structure is reacting to all of this fundamental risk and these high-stakes catalysts. Let's look under the hood of the technicals.
Yeah, let's do that, because the short-term trend is, objectively speaking, awful.
It's bad.
Over the last 13 weeks, the stock is down 28.76%. It has been a relentless, slow-motion bleed. Now, if you zoom into the daily action, it looks like it is desperately trying to build a base and find a bottom near that $12.90 intraday low.
Right, trying to stabilize.
But we have to keep context in mind here. Even with this horrific 3-month drawdown, if you look at the trailing 52 weeks, the stock is still up 97.72%.
It's a huge point.
Yeah, it's technically still in a long-term structural uptrend, even though the short-term momentum has just completely collapsed.
And this is where things get truly fascinating. Because when you stop looking just at the price and start looking at the volume and the actual flow of shares, a massive bullish divergence is forming.
What are you seeing?
First, trading volume is completely drying up. The 10-day average volume has shrunk to just 0.66 times the 3-month average.
So the aggressive selling pressure is basically exhausting itself.
Exactly. When you see volume dry up at the bottom of a massive drop, it usually indicates that the weak hands, the short-term traders who got spooked by the integration costs, have already liquidated their positions.
Makes sense.
But a lack of selling isn't enough to reverse a trend. You need buyers. And that is exactly what we are seeing from the most important demographic possible, corporate insiders.
This is the part that really caught my eye. Management is essentially eating their own cooking right now.
Aggressively so. Over the last 90 days, there has been heavy accumulation. We're talking about 17,730 shares bought by insiders across multiple transactions. And here's the kicker.
Let me guess, 0 sells.
0 sells. Not a single executive has dumped shares. That triggers what analysts call a 100 maximum sentiment price ratio, meaning 100% of insider action is pure buying.
Honestly, that is the most compelling data point we have discussed today. When the CEO, the CFO, or board members are aggressively buying their own stock in the middle of a 28% quarterly drawdown, it cuts through all the noise.
Absolutely.
It speaks significantly louder than any polished press release or forward-looking guidance. They are literally putting their personal net worth on the line because they clearly believe the open market is mispricing the long-term value of the VAC acquisition.
But it begs a psychological question, doesn't it?
Yeah, why is the market still punishing them?
Exactly. If the insiders who know the company best are buying hand over fist, why is the broader market still punishing the stock so relentlessly? What's driving the sentiment?
It comes down to a harsh, unforgiving sector rotation. The broader uranium sector is undergoing a very sharp correction right now. In environments like this, institutional investors and trading algorithms stop caring about your 10-year potential.
They just want safety.
Right. They aggressively reward companies that are currently profitable, and they ruthlessly punish any company that is burning cash. Because this company is currently burning massive amounts of cash to integrate VAC, the market is lumping them in with the speculative, low-quality developers.
It's guilt by association. When you have a high beta to a specific sector, you are tethered to its mood swings. The uranium sector goes out of favor, and institutional algos just indiscriminately sell everything with a rare earth or uranium tag attached to it.
But interestingly, if you look at the media mood, it is actually diverging from the brutal price action.
Oh,
Yeah. The headlines are surprisingly measured. You are seeing mainstream financial press run stories titled, Energy Fuels Just Made a Bold Bet on Rare Earth Magnets. They aren't calling it a disaster. They're viewing the VAC deal as a necessary shield.
that's a good way to look at it.
The press actually recognizes that this acquisition prevents the company from being just another speculative miner completely at the mercy of daily spot prices. It elevates them into an advanced materials manufacturer.
However, before anyone listening gets too excited by insider buying and cautiously optimistic media headlines, we have to ground this analysis in the absolute worst-case scenarios.
Yes, we have to outline the bear case.
The execution and debt risks are paramount, and they just cannot be overstated. As we touched on earlier, merging corporate cultures and supply chains across North America, Europe, and Asia is a logistical nightmare.
Completely.
If this massive $1.9 billion deal is heavily debt-financed, and an acquisition of this magnitude usually is, they're exposing themselves to brutal interest rate risks. If interest costs remain high, or if the integration takes 18 months instead of 6 months, it delays the cash flow they desperately need.
And that scenario will crush an already bleeding net margin. They could literally choke on their own debt before the synergies ever materialize.
And you absolutely cannot ignore the commodity headwinds. The long-term transformation to a magnet manufacturer is a brilliant strategic move, but in the short term, they still have to pay the bills. And they rely on their mining cash flows to fund this grand pivot. Right now, vanadium prices are falling sharply in China, and the broader uranium sector is, as we mentioned, correcting.
Which creates a dangerous domino effect. If the spot prices for their core mine commodities don't bounce back, their operational cash flow simply dries up.
Yeah.
And if the operational cash flow dries up, they have no internal engine to fund the manufacturing integration.
Exactly.
That forces management into a terrible corner. They either have to take on more toxic high-interest debt, or they have to massively dilute their existing shareholders by issuing more stock at these depressed $13 levels just to raise capital. Both of those scenarios are absolute value destroyers for anyone holding the equity today.
So, with all the upside potential and downside risks fully laid out on the table, what is the final verdict on this transformation story? We have a company undergoing a massive, expensive identity crisis, balancing extreme insider confidence against severe balance sheet and integration risks.
Well, looking at the underlying data, the long-term strategic positioning, and the current compressed valuation, the overall bullish score comes in at a 7 out of 10.
Let's summarize the core thesis for you, the listener. The elevator pitch is essentially this. You are looking at a deep value entry point into a company attempting to build a future Western duopoly for rare earth magnets.
The moat is the magnet.
Right. The broader market is currently punishing the stock for the painful short-term accounting costs of a $1.9 billion acquisition. But that exact acquisition is what ultimately secures their long-term competitive moat.
But anyone considering this has to understand the timeline.
Absolutely. The target horizon here is strictly a multi-year hold. This entire thesis relies on the complex, successful integration of the VAC facilities, combined with slow-moving geopolitical shifts away from Chinese supply chains.
So not a quick flip.
Definitely not a quick flip. If you're looking for a rapid, V-shaped bounce over the next 3 weeks, the structural risks here are simply too high. But for thesis-driven portfolio growth over a 3 to 5 year window, the foundational pieces are absolutely in place. And as a final reminder, this analysis is purely educational and should not be taken as financial advice.
And if you want a visual edge when you are analyzing these charts for yourself, make sure to check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite featuring trend direction tools, support and resistance zones, visual buy and sell alerts, and dedicated take profit and stop loss planning areas.
It's super helpful.
It is designed to help make charts easier to scan, but remember, it is an educational chart analysis tool only. It is not financial advice, it does not trade for you, and it guarantees no results. Trading involves serious risk, so always do your own research and manage your downside. That is an affiliate link, meaning we may earn a commission at no extra cost to you.
If this analysis brought you some clarity today, please consider subscribing, hitting the like button, and leaving a comment underneath. We'll see you in the next Smart Wealth with Joshua Talk. But before you log off, I want you to ask yourself a question as you look at the macro environment. When the world's largest militaries completely redraw their supply chains over the next decade, Will your portfolio be holding the companies that simply own the mines?
Or the companies that own the monopolies?
Exactly. Keep that in mind.